Hey everybody, this is RC Peck, and this is my weekly video where I bring up 1 to 3 charts or news stories that really capture or get my attention and why it matters for retiring and retiring strong. It's fun to look at this information. It can be entertaining, but what matters most is to make sure that your portfolio is protected in your retirement. So let's keep kind of focus on the point of these videos. Okay, so with that, whether you are 30 or 60 or 90 years old, these 3 charts, these 3 stories matter because it impacts what's going to happen in 2023. So let's do this. Let me get over to the first chart here. So if you look at this, actually, let me tell you where this came from. So this is a tweet, and it says, add to that presidential cycle and the odds are still good for a year-end rally. So let's talk about whether we're going to have a year-end rally. So the Santa Claus rally typically is the last 5 trading days of the year and the first 2 trading days of the new year. Okay, and typically there's a high probability that the market goes up. It's a little less than 2%. I think the probability is something like 79% of the time it does go up 1 point something. The point is that it's a very high probability. But we're not really having a rally in December. If you look at the price chart, now I'll zoom in on this one. Rottler VR, just so we know who this comes from. What I wanted to point out to you on this piece of information is it's all years in the black, all midterm years. Okay, the gray is Democratic presidential midterm. The green is the first term midterm years and second new year Democratic president. So we have 5 different periods. Notice in December, all of them go higher, right? Meaning December is a really good month for stocks. So here's the thing. We have to keep a watch on this because if it's not a good time for stocks, it typically doesn't set up for a good time in January. And if there's not a good time, a good market performance in January, it typically means it's going to be a harder year for stocks. So let's look at what stocks have been doing in December. Now I'm recording this early in the week. It is close of market on Tuesday, but just we get what's going on so far. This is the S&P via SPY. And so far month to date, the S&P, I have to put my glasses on, everyone. The S&P with dividends re-included is down 6.4%. So this thing not only has to start rallying soon because there are not many trading days left. Today is December 20th. So we don't have many days left to trade. Not only does it have to make up that 6.4%, but then it has to go positive. And every day it doesn't, it puts more weight on the market. Sorry about that, everyone. I usually have that on vibrate. It puts more weight on it being a down year in 2023, right? When the market can't do what it's probabilistically supposed to do, puts a lower probability that it's going to be an up year. And so far, it's not looking like that. The year is down as it is, and the last month is down so far, and that starts to put the Santa Claus rally in question too. So December is historically, it's a very strong month, and right now it is not looking good. Okay, the second piece of information, the second kind of story I want to bring out is from Lynn Alden. And she's simply pointing out here, based on this one metric of banks and their overall willingness to lend, if that willingness starts to contract, it's not a good sign, and it can often preempt or happens before a recession. So contraction happened before the 2008 recession, the 2000 recession, and the 1990 recession. And now banks are contracting again, like their willingness to lend is contracting again. So that's not good. That also leads to a potential weaker stock market for 2023. Now here's a price chart of KRE without dividends reinvested. This is just regional banks here in the US. And what took my attention is that this price is flirting with pre-COVID high. Now, so far it's stayed above. Again, this is KRE, Regional Banking ETF. It has kept its head above water, keeping that price above pre-COVID high. But man, it keeps knocking on that floor. And if the economy was getting stronger and healthier, banks would be lending more, they'd be having more revenue, more income, earnings would be doing well. But based on KRE here, again, regional banks, it's not looking good, which this aligns with the previous story I told you about. Let's also quickly look at it, just a couple other. Bank of America, not looking that good. Now, this is with dividends reinvested here, but it's still below its pre-COVID high. B of A is one of the larger banks in the country. And of course, let's quickly look at Blackstone, because that has just been hitting new lows. It continues to hit new lows. The SEC is now asking questions of Blackstone and Starwood about their B-REIT, basically their non-tradable REITs, their non-tradable funds. The SEC is just having some questions for them. And so you see Blackstone down now almost 49% from its, let's call that November 30th of last year. So about it's its all-time high there, and it's down 13 months and counting. Okay, now the third story. So this comes from Steve Straza. He says new lows for consumer discretionary sector, and he shows this price chart right here. So this consumer discretionary XLY, its two biggest components are Tesla and Amazon, and they represent about 31% of this symbol. So I thought we should look at Amazon here. It is not looking good. Here's its pre-COVID high here. It's well below that. And here it's COVID bottom low, and it's testing that. Probably some buyers will come in, but this is one of the best run companies on the planet, and it is not looking good. Let's see what this is down from its high. Down from its high, it is down about 55%. The other massive component is Tesla. This is about 15% of discretionary. And it's down 8% just today on Tuesday, close of market. As I say again, I'm recording this on Tuesday because of the holidays. Tesla now is down 67%. 67%. It would not surprise me if Tesla came down about 85% to pre-COVID high, especially if, well, we are moving into a recession. It's probably the most anticipated recession ever. The question is, how bad will it be? How long will it be? We don't have a lot of those details, but what we do have is price charts telling us what's going on, and consumer discretionary is not looking good. Okay, so let's put the three together. So number one, we are in a period of the year where the market should be going higher. December historically is a very good year for stocks, and stocks are down month to date about 6.5%. That is not a good sign for a strong 2023. The second story is just about banks, right? It's hard for the economy to do well when banks aren't lending, when banks are contracting on how much they're willing to lend, and that is happening right now. And we also see regional bank ETF really, hoping to stay above their pre-COVID high. If it can't, that's not a good sign for the overall economy. And then finally, just looking at consumer discretionary things we don't have to buy. We don't have to buy Teslas. And apparently the people behind the S&P Standard & Poor's, they put Amazon in consumer discretionary too. Don't know why it wasn't in staples, but it's not. Those two together represent about 31% of consumer discretionary. So consumer discretionary is down and heading lower. I didn't show it, but it's down about 31% of the year. So as of right now, the markets are getting weighted down. They are still trending down in a period, in a month, in a time segment where they ought to be going higher. Let me know where you think I got it right, what you think I missed, what you think I should cover. I appreciate you all watching these videos. If you like them, please like, subscribe, and leave a comment, because it does make a difference, and then these videos get out to more people. Again, thanks again for being in my world, and I will see you on the next video. Okay, bye.